Hi, welcome to this explainer series brought to you by ALT. REITs, SM REITs, and InvITs have reshaped access to income-generating real estate and infrastructure assets in India. In this video, we'll explore why you should include these asset classes in your portfolio. We will also discuss their benefits, compare returns, and highlight how they fit alongside traditional investments like bonds, fixed deposits, and equities. First, let's explore the benefits. Stable income and regular distributions. REITs and InvITs must pay out at least 90% of their net cash flows to unit holders, making them akin to fixed income instruments. Investors benefit from regular quarterly income generated from rents, toll revenues, or other long-term cash flows. Portfolio diversification. Through REITs and InvITs, you gain exposure to multiple properties or projects, reducing the impact of any single asset's underperformance. Moreover, the returns from commercial properties or infrastructure projects often have low correlation with traditional equity or bond markets, improving the overall risk-adjusted return of their portfolio. Liquidity and accessibility. Unlike physical real estate, which is illiquid and requires large capital, REITs, including SM REITs and InvITs units, trade on stock exchanges and can be liquidated easily. Investors can access institutional-grade assets with relatively low ticket sizes, as low as rupees 100 to 400 per unit for REITs and InvITs, or rupees 10 lakh for SM REITs. High liquidity and low ticket sizes is a significant benefit, as it combines real estate exposure with the flexibility of listed securities. Regulated structure and transparency. Regulated by SEBI, these investment products must adhere to strict disclosure and performance update standards, independent valuations, and strong governance. They are managed by professional asset managers, ensuring that properties and projects are run efficiently. Such institutional-grade management and reporting reduce the risk of fraud or mismanagement, unlike typical real estate where information can be opaque. Inflation hedge and capital growth potential. REIT and InvIT revenues often have inflation-linked characteristics. Commercial leases have built-in rental escalation clauses, typically 5% every year or 15% every 3 years. Toll or tariff rates in InvITs can be indexed to inflation, linked to CPI or WPI indexes. This leads to increase in distributions, providing a hedge against inflation, as well as increase in unit price, further providing long-term capital growth. Now, let's move on to discuss returns. Indian REITs and InvITs are fundamentally income-generating investments with a capital appreciation kicker, so a large portion of their return comes from regular distributions. Rentals from the tenants in REITs and user charges or tariffs in InvITs are distributed to the investors, creating a stable and regular rental income. Current distribution yields, based on fiscal year 2025 for listed REITs, are 7 to 8.5%, and in the range of 8 to 15% for InvITs. As the value of the underlying real estate grows, so does the unit prices. Additionally, both REITs and InvITs continue to acquire projects, thus leading to long-term capital gains. Since their listing, REITs and InvITs have delivered attractive annualized returns to investors, combining for both capital appreciation and regular income distributions. Here's how they compare across different time frames. Now let's compare these asset classes with traditional equity and fixed income instruments. Indian large-cap stocks, for example the Nifty 50 index, have historically delivered around 13 to 14% annualized returns over the long term, mostly by price appreciation and a small dividend yield of around 1.3%. REITs and InvITs, in contrast, target a more balanced return composition, a substantial current yield component and moderate capital appreciation. In comparison to equity, REIT and InvIT returns tend to exhibit lower volatility with a very low correlation. Nifty REIT and InvIT index have shown volatility of just 2/3 that of Nifty 50 index and a beta of just 0.23. Beta is a measure for correlation with Nifty 50 index, with the value of 1 implies that it is fully correlated to index. REIT and InvIT prices, like bonds, are sensitive to interest rates due to their dividend-like income-focused nature. When interest rates rise, new bonds offer higher yields, and hence, REIT/InvIT prices may face downward pressure to stay competitive. Conversely, if interest rates are expected to decline in the future, REITs or InvITs become more attractive, as not only yield-seeking investors flock to them, potentially driving up prices, but the financing costs also decrease, increasing the future distributions. The below chart clearly shows the hybrid nature of REITs and InvITs, right in between equity and debt, both in terms of returns and volatility. So REITs, InvITs, and SM REITs bridge the gap between fixed income stability and equity-linked growth. Their regulated structure, regular payouts, and exposure to quality assets make them ideal tools for building a balanced and resilient portfolio. You can invest in these unique assets through our Portfolio Management Service, or PMS, which offers active portfolio management by an experienced investment team, creating a customized portfolio based on investor objectives and risk profile. To learn more, log on to altinvest.ai today.